3 stocks that I'm going to buy next week. In the past couple of weeks I've been analyzing these stocks and they all got my attention for a longer period of time. And right now it feels that these stocks are the best stocks to buy right now. But what are your favorite stocks to buy? Let me know in the comments. In this video I'm going to show you a list of 3 stocks that I'm quickly analyzing and highlight the pros and the cons. In the last part I'm going to check the price target for each stock. I'm very excited to see what you guys think about these stocks, so please let me know your thoughts in the comments. And if you think a company is missing in this list, please let me know as well. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So first stock on this list is Etsy. It has been on my buy list for a longer period of time and I'm a big fan of the business and also the stock, which are two different things in my opinion. Etsy operates a top 10 e-commerce marketplace operator in the US and the UK, with sizable operations in Germany, France, Australia and Canada. The firm dominates an interesting niche connecting buyers and sellers to its online market to exchange vintage and craft goods. Etsy has the 52-week high of $307 a share and a 52-week low of $68 a share. And I wish I had bought at the time, but unfortunately I didn't. Etsy is a 13.6 billion market cap company with PE ratio of 31. So this means you pay a premium for this stock. A second ago we saw that it went down from $300 to $68. Right now it's at $107 as of recording this video. It means that it was massively overvalued in the past couple of months. In this graph we see that the revenue went up quite a lot in the past couple of years, especially during the lockdown periods, where Etsy really took a big jump in revenue. After the lockdown periods, revenue started to slow down a little bit, so definitely keep this in mind. Profit margin is very steady and consistent and sitting at 18.5%. I think this profit margin will go up in the coming periods or years when the platform becomes bigger and bigger. In this graph we see that free cash flow went up quite a lot during the lockdown periods again, and probably will slow down in the coming periods of course. Same story as the revenue growth. But if we focus on the periods before the lockdowns, we see a nice and consistent pattern, so I really like this a lot. And to me it's very important that free cash flow is growing, since this is used to pay down debt, buy back shares, do acquisitions, research and development, and of course pay dividends, which they don't do right now. A thing that I don't really like about Etsy is the fact that they issue new shares. This dilutes you as an investor. But to be honest, I get why they did it. The stock was massively overvalued and people were buying Etsy stock. So why not issue a lot of new shares to raise capital instead of taking debt? So although I don't like the shares outstanding right now, I understand why they did it. The good part is that in the latest quarter shares were decreasing. A great thing about Etsy is the cash to debt ratio. For a company like Etsy you would expect higher debts to grow the business in relation with the cash position. But when we check the balance sheet we see that total cash is at 1 billion and total debt is at only 2.4 billion. So they can't pay down 50% of the debt. But for a young company like Etsy, I think this looks really good. And this is also because of the lockdown periods of course, where they made a lot of money. So keep an eye on this number, but for now I'm happy with current levels. Last part for this quick analysis will be about the price target that I created using the Everything Money software. We have to fill in a low, mid and high assumption for some key metrics, starting off with the revenue growth. I'm filling in 10, 12 and 14%, which are all below the average for Etsy. So I'm a bit conservative for the revenue growth, since I think growth will start to slow down just a little bit. Profit margin is very consistent, so I'm filling in 18, 19 and 20%. For the free cash flow margin I'm going for the average, so 22, 24.5 and 27. PE ratio is a bit high at 31, but since this is a growth stock I'm going for 21, 22 and 23. Same story for the price to free cash flow. My desired annual return is 12.5%, since I can get an easy 10% return with owning an ETF. Right now Etsy is at $107 as of recording this video. I hit analyze and we see some green numbers. We have a low price target of $74 to $90, which is around their 52-week low. A mid price target of $94 to $121, which is around the current stock price, and we have a high price target of $190 to $160. I think Etsy is a great stock to buy at low prices, since it has a lot of potential. As I told earlier, I wish I had bought the stock around the 52-week low, But to be honest, I think there's still a lot of potential in this stock price. I'm going for the range of mid to high price target, which means $94 to $160, which is quite a big range. But right now it's at $107, so more than enough room to grow in the coming periods. Second stock on this list is Texas Roadhouse stock, ticker symbol TXRH. This stock has been on my watch list and buy list for a long period of time. And I'm a big fan of the business and also the stock. And again, these are two different things in my opinion. Texas Roadhouse is a restaurant company predominantly in the casual dining segment. The company operating segment includes Texas Roadhouse, Boba 33s and others. It generates maximum revenue Texas Roadhouse segment. TXRH has a 52-week high of $97 a share and a 52-week low of $68 a share. This means that they are almost at the 52-week high. But I think there's still some more potential for the stock. TXRH is a 6.3 billion market cap company with a PE ratio of 24, which means you pay a small premium for this stock. But keep in mind that this stock was hit by the lockdown periods and it went down from a 40 PE ratio on the 5-year average to 24. So I think this PE ratio will go down, also because they are buying back shares, which we will discuss in a second. In this graph we see that revenue went up really nice and steady in the past decade. During the lockdown period it went down, of course, but after that it really took a jump again. I expect things to return to normal growth levels, which is fine by me. The current profit margin is at 7%, which is really great for a restaurant business, especially since it's above the 5-year average of 5.7%. So I really like that number as well. In this graph we see the free cash flow, which is very important because this is used to pay down debt, buy back shares, pay dividends, do acquisitions, open new restaurants and research and development. Since 2015 it went up really nice and steady, except for the lockdown periods of course. So I really like this pattern a lot. I think it's very consistent for a restaurant chain. In this graph we see that the shares outstanding, which are going down in the long run. We see some increases every now and then, which is something I don't like in general. But the stock was overvalued back then, so I don't blame them. In the latest quarter they start to buy back shares again, and that's something I really like. Another thing that I really like is the fact that for a restaurant business, coming out of lockdown periods, debt is really looking good, compared to the operating cash flow. Right now they have 470 million in operating cash flow and 180 million in total cash. Debt is sitting at 756 million, so this looks really good to me. And next up are the dividends. Right now, dividend yield is at 2% and payout ratio is at almost 47%. This means they have 53% left in cash to pay down debt, buy back shares, open new stores and all other things. And now the good part, the 5-year growth rate. It's at 17%, which is really high for a restaurant business. They grew the dividends for 0 years in a row, which may seem bad, but they cut the dividend during the lockdown periods, which was a smart move in my opinion. When things started to cool down, they immediately start to pay dividends again. So a great decision by the management in my opinion. The last part of this quick analysis about TXRH will be about the price target that I created using the Everything Money software. I'm filling in a low, mid and high assumption. For the revenue growth I'm aiming for 10, 11 and 12%, which is lower than the 5-year average, but I expect that growth will slow down a little bit. For the profit margin I'm using the averages. So I'm filling in 6, 7 and 8% on the high side. For the free cash flow margin I'm filling in 6, 6.5 and 7%. PE ratio is at 24 right now and I'm aiming a bit lower, so I'm filling in 20, 21 and 22. It's the same story for the price to free cash flow. For my desired annual return I'm filling in 12.5% since I can get an easy 10% return with owning an ETF. Right now TXRH is at $92. I hit analyze and we see a lot of green numbers. We have a low price target of $78, a mid price target of $94 to $101 and a high price target of $130 to $129. To me the mid to high range is the most justified here, so $94 to $130 a share. My final conclusion on this stock is that I think it's a great addition to my portfolio. Management is doing really great and for a restaurant business the fundamentals look really good. So I'm going to buy the stock next week. And the last stock on this list is TROW price, ticker symbol TROW. A friend of mine reminded me about this stock, and since then I added it to my watch list. I think this could be a hidden gem. TROW provides asset management services for individual and institutional investors. It offers a broad range of no-load US and international stock, hybrid, bond and money market funds. TROW has a 52-week high of $224 a share and a 52-week low of $106 a share. Right now it's at $126 a share as of recording this video. To me it seems that there's still a lot of potential in this stock. TROW is a 28 billion market cap company with a PE ratio of 9.95, so let's call it 10, which is very low of course. The 5-year average is at 13, so this tells me that they might be undervalued. Revenue is going up quite nice and steady, but it went down a little bit in the past quarter, which is something to keep your eye on. Profit margin is at 37.6%, which is slightly above the 5-year average, so this looks really good to me. Free cash flow is going up in the long run, but it's not always steady and consistent. So check this number from time to time, since you want them to be steady and consistent, since free cash flow is used to pay down debt, buy back shares, pay dividends, do acquisitions and research and development. A thing that I do like about TROW are the shares outstanding. It's going down big time over a longer period of time. But again, it's not really consistent, so that's something I really don't like. In the past 5 years they bought back 5.7% of the shares outstanding, which could be higher in my opinion. Another thing that I do like about this company is the fact that they can pay off all their debt and even have left cash to do other things. Right now TROW has 2 billion in total cash and 3.3 billion in operating cash flow. Total debt is at only 307 million, so less than 10% of the free cash flow, which is really impressive. Next up are the dividends. Right now dividend yield is at 3.8%, which is really high. Payout ratio is at only 42%, which is quite low compared to the high dividend yield. This means they have 85% left in cash to pay down debt, buy back shares, do acquisitions and all other stuff. The 5-year growth rate is at 15% and they grew the dividends for 35 years in a row. Overall, this dividend scorecard is really impressive and probably the best scorecard in this list. Last part of this analysis is about the 3 price targets that I created using the Everything Money software. I'm using a low, mid and high price target. For the revenue growth I expect things to slow down a little bit, so I'm filling in 5, 6 and 7%. For the profit margin I'm also a bit conservative and filling in 30, 32 and 34%. For the free cash flow margin I'm filling in 26, 28 and 30%, which is around the averages. For PE ratio and price to free cash flow I'm filling in 10, 11 and 12%. For my annual return I'm filling in 12.5%, since I can get an easy 10% return with owning an ETF. Right now TROW is at $126 a share. I hit analyze and we see some green numbers. We have a low price target of $104 to $120, which is slightly below the current stock price. A mid price target of $125 to $143, which is above the current stock price, since it's sitting at $126 right now, and we have a high price target of $150 to $170. My final conclusion on this stock is that I think it's a great dividend growth stock. Both value play and dividend play look really good, and the fact that they have almost no debt comforts me a lot. So I'm buying TROW stock next week. So this was the list of 3 stocks that I'm going to buy next week. I'm very excited to see what you guys think about this list, so please let me know your thoughts in the comments. I think all the 3 stocks have a lot of potential and have different reasons why I'm going to buy them. Etsy has a lot of growth potential, while TXRH and TROW have potential and also pay a good dividend. For now I'm waiting for next week so I can buy these stocks. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.